bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the October 10th, 2023 podcast. This episode is another installment in our recurring So You Want to Be a LIHTC Developer podcast series. This podcast series is focused on helping real estate developers learn more about building affordable rental housing using the low-income housing tax credit and private activity bonds. The low-income housing tax credit, often called LIHTC, is the key federal incentive in America today to finance the construction and renovation of affordable rental housing. The incentive is used to raise tax credit equity to make rent-restricted rental housing affordable to low-income families. Previous topics that we've covered in this series include the difference between 9% and 4% tax credits, the importance of location and market considerations, as well as our most recent September 26th episode on some of the common oversights in developer-prepared financial forecasts. If you're a real estate developer interested in learning more about the low-income housing tax credit, I highly recommend that you check out our other episodes. You can listen to them in any order you'd like, or you can skip around to the topics that most interest you. I'll include links to the other episodes in today's show notes, which you'll find posted at www.novoco.com/podcast. We also have a dedicated playlist of these episodes on our YouTube channel. Now, another great resource where you can learn more about the low-income housing tax credit and private activity bonds is our annual Novogradac 2023 Housing Tax Credit Finance Conference, which is coming up November 30th to December 1st in Las Vegas. One of our panels will focus on how to make your development more attractive to syndicators and investors. So whether you're new to the low-income housing tax credit or you have some experience already, I highly encourage you to join us for that event. I also invite you to sign up for one of our pre-conference workshops that will be held on Wednesday, November 29th. We're offering 3 workshops for all levels of low-income housing tax credit experience. We'll have a LIHTC Basics workshop. We'll have a Year 15 workshop, and we'll have a Running the Numbers workshop on the sources and uses in a tax credit development. I will include the registration information in today's show notes, but you could also simply Google Novogradac events, which should bring you a link to our conference registration page. Now let's get back to the topic at hand. In today's episode, we're going to discuss some key concerns that syndicators and investors often have with particular transactions. We at Novogradac think that developers should make an effort to understand these concerns, and that way they can avoid potential adverse consequences. They can better ensure they're complying with their obligations under their agreements with their investors and syndicators, and they can better avoid unexpected surprises down the road. And we all like to avoid unexpected negative surprises. Now, my guest today is my partner, Stacey Stewart. Stacey has years of experience working with various low-income housing tax credit investors and syndicators. And Stacey's on the show today because syndicators regularly consult with her about a variety of issues that they encounter with their LIHTC developments. Now, preparing for this podcast, Stacey and I identified 5 major investor concerns that we think developers should better understand. Now, the 5 are, first, the importance of accurately estimating the timing of the projected tax benefits, which are namely tax credits and tax losses. Second, the importance of satisfying the administrative requirements that developers commit to under the partnership agreement with their investor. Third, the importance that the allocations of tax losses be respected. Fourth, what investors expect at the end of their investment period. And then fifth, which somewhat ties into number 4, that the effect of having a significant positive capital account could have on investors' rights to share in cash at the end of the compliance period. We have a lot of useful insights to share in the course of the podcast. So if you're ready, let's get started. Stacey, welcome to Tax Credit Tuesday.
Thanks, Mike. Happy to be here.
And if I'm remembering correctly, this is your first appearance on the show?
It is.
So thank you very much for joining me. So please, before we get going with the 5 topics that we identified in preparing for the podcast, I'd like if you could share with our audience a bit more about your background and areas of expertise at Novogradac.
Sure. So as Mike mentioned, I'm a partner here at Novogradac. I have been with the company for almost 20 years. It'll be 20 years this January. So a long time. Um, I do audit tax consulting work for developers, syndicators, investors in affordable housing. Am the technical editor of the general tax credits for the LIHTC section and also the low income housing tax credit handbook. And I say my most recent years, I've mainly been involved with syndicators and investors in doing work for them. And so I do see on a daily basis some of the issues that they encounter. And so I think I can bring some good insight on our topic today.
Great. Thank you, Stacey. I know that you will. Now, as I said in my introduction, syndicator and investor clients, I know they often reach out to you at various times to help address some areas that are causing them concern. When I say various times, it's sort of for our listeners, it's at the beginning before the syndicator or the investor invests. And then beyond that, it's over the course of the development phase, the 15-year compliance period, and then ultimately at the end when the investor is exiting the partnership. And as I noted also in the introduction, we have 5 major investor concerns that we want to share that developers should be aware of, and more importantly, should understand and address. And the first on our list was the projected timing of tax benefits, which might seem like it's a given. Of course, you care about the timing of tax benefits, but I think it's important that when developers are working on their projections at the beginning of the development and when they're drafting the partnership agreement, that they're aware of 2 overarching factors that affect the timing of the delivery of tax credits. If you're listening, you might be thinking, what are those 2 overarching factors? One, I'm sure any listener would get, and that's the rules, the statutory rules about when you claim tax credits and tax losses. What are the technical Internal Revenue Code rules as to when a development is able to generate tax credits and losses? And it's not so much the statutory one that sometimes causes concerns, even though that can. The second one, are the administrative rules. And namely, when I say administrative rules, and when Stacey and I were developing these topics, which she and I kind of landed on, is how the manner in which a credit allocating agency oversees tax credit allocations in their jurisdiction, and how the manner in which they administer the incentive affects the actual delivery of tax credits to investors. So with that as background, Stacey, if you could elaborate on both the statutory and administrative issues that cause the most concern among investors.
Sure. So as an investor, they're investing to get a certain internal rate of return. I mean, that's why they're investing, in that internal rate of return is based off the credit and loss benefit delivery. And so if there are issues with timing, if you promise credits in 2023, but they don't deliver in 2024, there are equity adjusters generally in the partnership agreement. So the investors are going to say, well, I'm going to get this certain internal rate of return. And if you don't deliver, then you're going to put less money into the partnership because I need to figure out how to get my internal rate of return back to where I expect it. And so those are all built in. And, the developers and investors, they understand there could be delays in that. And they understand the real estate delays, which could be construction delays. If you're developing any kind of real estate, there could be construction delays, there could be lease up delays. But one of the important things that I see that's a concern is the actual administrative delays of getting their Form 8609s. Because that's sort of the golden ticket. That's what you need to do. And that's what you need to have in order to claim those tax credits. So the issue comes when you go and you do all the things that you need to do to get those credits delivered in the first year that you expect. You go and you build the project, you lease another project, you do your final cost certification, your place and service package, and that has to be submitted to the state agency. Then the state agency, gets that, they, review that, and then they issue your Form 8609s. But the problem is that you're supposed to have those 8609s before you file that tax return. And you had to file that 8609 with the Internal Revenue Service by the end of your first credit period. And so you might have all this done, but you have it done, but you don't have it in time to file that tax return. So is there an issue? Can you file that tax return without those credits? Because you need to, right, in order to make that delivery that you promise for your tax credits. And so what does the, instructions say for the tax return? So the one thing that you have to look at is the tax return requirements is that you're supposed to file Form 8609A. And if you look at Part 1 of Form 8609A, it says, do you have your, original and signed 8609s from the state allocating agency? And if you mark yes, you're all good, you complete Part 2. If you mark no, it says, do not complete Part 2 of this form, stop here. And so the issue is if you don't have them and you stop there, you can't fill the rest of the form. And that's where you show your delivery or tax credits. That's where the tax calculation is. That's how it gets flowed to the rest of the return. And so if you don't have that, you're not delivering those credits as expected. So you might say, well, what if I get it a few months later? Can I just do an adjustment to my tax return and then file an adjustment and report those credits? Then I will be then delivering as expected. Well, the issue came up, especially in the beginning of 2018. In 2018, there were some new rules called the Centralized Partnership Audit Regime, which they also call the BBA. And it does have a significant effect on credit delivery. So let me give you an example of these new rules. So let's say you were expecting credits in 2003. So that's the first year you're promising credits. And you've done everything that you need to do. You got everything built, constructed, leased up, you submit for your final cost certification, but you just don't have those 8609s yet. So you're like, okay, so I'm not going to file this return because I don't have the 8609s yet. And I'm going to file it with credits. So you're expecting credits in 2023. But by the time you get that cost certification finished and submitted to the state, what could be closer to the end of sometime in 2004, and then the state agency, they need time to review that. They might have some questions. There might be some going back and forth. There's just a lot going on with the state agencies. They have a lot coming in. And so let's say it's right at the end of 2004 where you get that Form 8609. And so then you're like, okay, well, I'm going to do this adjustment. Well, the new rules is that you file this form called Form 8985. So now you're in 2004, you're doing this form probably in 2005 now. And so you're filing this form, you're reporting the adjustment. So basically you reported that you had 0 credits on your original return. And then let's say you're 8609 and based on our calculations, you have 100,000 in credits. So you show the new amount of credits and you show the adjustment, which the adjustment is $100,000. And so what the new regime says is that, well, then you can pass that adjustment along to your investor. So the partners in your partnership by filing Form 8986. And that will report that change to your investor. And the investor then can claim that on their tax return. The problem is that form and that adjustment, if you get that in 2005, you have to report it in the year that you receive the adjustment. So even though you're changing a 2023 tax return, you're not getting that until 2025. And that goes into the investor's 2025 return. So, of course, nobody wants that. That's a delay in credit delivery. It could cause the IRR goes down for the investor. cause equity adjustments, right? So to the development, and nope, that's not the result that we want. So when that came out as an industry, we started looking closer at the Internal Revenue Code and its regulations. And the practice now prevalent in the industry is to use this approach that they call the reasonable cause approach to claim credits in the year that they were supposed to be delivered. So let's say 2023. So what this approach is looking at the code in Internal Revenue Code section 42L. It states that if you failed to make certain certifications before the end of your first year of your credit period, then you cannot claim the credit unless you have reasonable cause, not willful neglect. And those certifications under 42L are those questions on your 8609 that you must answer in the bottom part. So what is your minimum set aside, or if you're making the multi-building election. So those certifications are made on form 8609. And then that form has to be filed with the IRS for the first year of claiming credits. And it says you have to do those certifications, make these certifications by that time, or you can't claim the credits unless you have reasonable cause, not willful neglect. So stepping back and looking at all this, people are like, well, I can't make these certifications, right? Because I don't have the 8609s. So I can't file that with the IRS. But I don't have willful neglect. I didn't just not build the project and try to claim credits. I've checked all these boxes. I did everything in my power to deliver these credits. I built it. I leased it. I filed the cost certification with the state in the place and service package. I'm just waiting. I've been talking to the state, dealing with everything. And there could be a full podcast on reasonable cause, or maybe what goes into that. And so under this code section, they're filing the tax returns with the credits, attaching what maybe their certifications are going to be, explaining the reasonable cause. And then when they actually get the form 8609 from the state, going back in and looking and say, okay, now we have the form 8609. Did I claim the same amount of credits I was supposed to on my tax return, or do I have some adjustments? And so there might be a few adjustments, then they might have to go through the whole process I discussed by finding the 8985, 8986. But it's not like going from 0 credits to $100,000 in credits. You might be going from 100,000 to 95,000. So maybe it's just a 5,000 adjustment. It doesn't have as great as an impact on the investor and the internal rate of return that they're getting. And so that's sort of, I guess, the importance of this reasonable cause approach and using maybe accountants in this industry that understand the significance of this and some of the rules and intricacies behind Section 42 and what the industry is doing. Because you don't want to not claim the credits based off, can't making that checkbox and maybe be subject to more adjusters and penalties than you thought. So that's a federal perspective.
Let me just actually interject there. I want to emphasize for the listeners the fact that the reasonable cause approach does imply the developer and their team has done everything that they can to get the 8609, including filing cost certifications and the like. So it is something that from an administrative requirement, the developers want to ensure that they're meeting those requirements of the credit allocating agency in order to avail themselves of the reasonable cause approach as most tax professionals, investors, and the like have gotten comfortable with. But let me hand it back to you because I know there's a yeah, but here.
Yes.
So go ahead.
And that is state tax credits. So the industry has got pretty comfortable with the reasonable cause if you met all those conditions that Mike discussed. And you filing that tax return with those federal credits. Well, there's a lot more state tax credit programs out there. And there's a lot of interest in those state credits. I mean, you might have access to more investors now, right? Because there's some investors that just want those state credits, and there's more states that are developing these kind of programs. So I've been seeing a lot more investors come in the industry just to get those state credits. And you can bifurcate most states, those state credits from the federal credits. That means like the federal credit can go to one investor and the state credit can go to somewhere else. And so you might be negotiating your deal terms with a couple of different investors if you have federal and state credits. So the problem comes is that there are a lot of states that don't accept this reasonable cost. Um, so I guess what I have seen, and I guess maybe a little bit of history with the federal um, program, is that there is something called the um, IRS Audit Technique Guide for Section 42. So the Internal Revenue Service has different audit technique guides for different industries. And it serves as guidance. You can't quote it like in a court of law. It's not law, but you can sort of see how the IRS auditors may audit particular areas. So if you come under audit because of credits and looking at credits, the one thing it says, somebody can produce their 8609 upon audit, right? So if you maybe file in the reasonable cause approach and they come under audit, and by the time you're under audit, you have the 8609, it sort of makes people feel more comfortable about claiming those credits so that IRS is going to accept your return as is. And so this approach, along with the reasonable cause, is sort of going hand in hand. And the thing with the IRS audit is they don't happen generally right after you file your return. Like you don't get in a notice right away. Now with states that I found, what I see is you're not necessarily getting audited right away, but they're quick to give notices. And so when they give notices, I generally see it around state tax credits. And I see the notice maybe within a month of filing that tax return. And so a lot of times you're not going to produce that probably upon getting that notice because you only have a limited amount of time you have to respond, usually 30 days. And so, I mean, a lot of the notices, they're trying to match up the credit you're taking as the fund or investor to the developer's return. And maybe they can't match it up because there are a disregarded entity in there. Or maybe there's some kind of documentation. There's a lot of documentation that some states require. Maybe you're missing like one piece of the documentation or form, but you have it, but you just need to submit it. And so I do see that often. That's why I see doing state returns in every state. I do see that. And I do see states quick to look at state tax credits and do you match that lower tier entity? So with that developer filing the return, and also do you have that documentation? And so California and Georgia, for example, they have come back, and if you don't have all that documentation, and the documentation is either the 8609 or their equivalent state form, they're not allowing that credit. And so they're saying no until you can't claim that till you actually get the form. So they're not using reasonable costs. So it's caused a lot of heartburn with the state tax credit investors because they're thinking like up front, I'm going to get this credit delivered at this point in time. Now there are some states like Hawaii, for example, that there must have been some good advocates for low-income housing tax credits and understanding that issue because they have revised their return instructions to say, okay, if you haven't got your 609 yet, you can actually submit it with your carryover allocation or your 42M letter and claim the credits. And then once you actually get your 8609, you can amend if for any credit changes, for any differences. So that difference of $5,000 I talked about before. So they're allowing that. So I guess I just want everyone to understand that state issue because I think that surprises a lot of investors and developers whenever they're getting into a new state and they realize it's almost September 15th, they're trying to file that return and sorry, but you don't have this and the state doesn't allow it. So just understanding, I guess I recommend understanding what state you're dealing with, what maybe their lag time is on getting their 8609s, when you expect to be placing everything in service and getting everything to them. And sometimes look at pricing, maybe it reflected for pricing, or you probably have an equity adjuster in there. Just understanding that it might be more likely than not that equity adjuster will be taking effect because of just how that state works. So just so you have no surprises, understand the state is what I'm saying. Yeah.
Thank you for that, Stacey. It's important to understand the state and I do think a lot of clients were aware about the difference in the reasonable cost approach with the state level versus the federal level. And I guess the good news from an advocacy perspective is our efforts in states that aren't allowing the credits until they have the 8609 to change the rules so reasonable cost can be used. Let's move on. We have 5 topics, and we dealt with the first one on statutory rules along with the credit administration rules. And the second area that we identified was the importance of developers reviewing, understanding, and satisfying the various administrative requirements under their partnership agreement with their investor. In the partnership agreement, developers make various commitments to deliver various documents and information to their investor by various due dates or deadlines. And investors impose these requirements because they themselves have some rather strict tax, financial, and regulatory filing requirements. So, Stacey, if you just wanted to give a quick overview of what some of the requirements are and potential adverse consequences to the partnership/developer if they don't satisfy them.
Sure. Yeah, as you mentioned, the entities that you're dealing with are either corporate investors themselves or their ultimate partners, corporate investors. So there's a lot of requirements that they have to meet. I mean, they need the information for estimated tax payments or extension payments. They have the regulatory requirements. They have their own audited financial statements that they're doing. So they need your audited financial statements in order to prepare their audit. So I guess just to give you a little bit more background on the timing, especially if you're a new developer, you might be used to government deadlines, such as if you're a partnership and your calendar year end, which most of our entities that we deal with are calendar year ends. There are some exceptions, but your return is due by March 15th to the IRS, unless you buy an extension and it's due September 15th. But the typical partnership agreements have deadlines that are much sooner than that. And so the most common deadline I see for tax returns is 2/15, so February 15th for draft, and then February 28th for the final return. But it could be sooner than that. So this probably sooner than a lot of developers have expected. They were thinking, oh, I got till September 15th. And I'm like, no, you really got to February 28th. So this is needed because there are many developers that are getting to their investors through syndicated funds, for example. And then the ultimate investor is the one who are in these syndicated funds. And the funds have reporting requirements to their investors. And so the fund needs time, the fund partner needs time to actually review the return, because they like to review the return to make sure that you're dealing with these special LIHTC and tax complex issues. And that they want to look at it and make sure that they don't see like anything that might need updated or changed. And then once they approve that, they have to give that to their tax preparers. And they a lot of times they consolidate all this information, give that to their tax preparers to produce their tax return. And their reporting requirements, I say generally what I see is 90 to 120 days after you're in. So no, you haven't everything final to them by February 28th, and they're having to have everything final to their investor by March 31st or April 30th, in March or April. If they get lucky, the end of April. So a lot of them are March. Sometimes they're even sooner. And so that doesn't really give them much time to review that tax return, go back and forth with all the issues, incorporate that information into their return, and then to deliver their product to the investor. So it's important that you understand those deadlines and why it's important to the ultimate investor. You also have audited financial statement delivery. And so the timing of that might coincide with the timing of the tax return due dates. I've seen that. I've seen another typical date I usually see is March 15th for draft and then the end of March for the final audit. A typical timeline for the syndicators to their investors are generally 90 to 150 days after year end. So in a March, April, and May is what I generally see in terms of what they get lucky May in terms of their investors, but most of them are sooner than that. And so the fund needs these audits from the developer because they have to incorporate this financial information into their audited financial statement. And they're dealing with a lot of properties because there's more than just generally one investment in one fund. So they're reviewing those financial statements. They're incorporating that into their books and records. And then there is just a lot of steps and procedure that go through for them to get that financial statement issued. So it's really a lot of work. And if the developer isn't meeting their deadlines, that means it pushes it back and the syndicators aren't meeting their deadlines to their investors. And so that's why you might get a lot of emails and stuff once you get close to the deadline. There are some other reporting requirements in the partnership agreements generally, besides those annual reporting requirements that are crucial. So some of them, for example, is during construction. There could be monthly construction reports or draw reports or leasing reports that are due, for example, maybe 15 days after month end. So it's maybe monthly reports. After lease up, there are, monthly status reports, financial and non-financial statements that generally have to be submitted. They might have like budget to actual comparisons, initial tenant file reviews, and those usually have a required date within the partnership agreement.
What's it? Of late.
Right. What are my consequences? What if I don't comply? Right. So I have maybe 3 big consequences. I'm sure there's more. But the first one is that if you're a developer trying to get into this industry or been in this industry, you probably want to continue doing work in this industry. And so if you're not meeting these reporting deadlines, then that's not going to maybe sit well with your investor because then it makes the investor not meet their reporting deadlines. And so if you want to continue to do work with your investors, you need to try to make your deadlines. You want to make sure you have a good reputation in the industry, that you are compliant and, you're meeting their deadlines. Because again, ultimately, this is a tax credit investment and you have to deliver, that tax return for the investor to get their tax credits. Or if you don't, there's no credits and then there's no point in investment. So you need to do it to be able to continue working and developing good relationships with investors and others in the industry. So the second one is that the partnership agreements usually impose fees if you're late. And so a lot of times I might see $100 a day for every day you're late reporting. And so that can really add up. And so a key thing is that sometimes there are extenuating circumstances that happen. And if you're always reporting on time, generally you have a good relationship with your investor, they might be more likely to abate some of these penalties if you are always reporting and there's just maybe an issue that's come up that you guys are working through. You have good communication with them. So again, importance of delivering timely when you can and developing that good relationship with the partners in your partnership. And then the last one is, I say, the most extreme, on the extreme side, but not delivering could be means of removal from you as a general partner in the partnership. And this is extreme and last resort, but I have seen it as grounds for removal when the delivery gets negligent. So don't be negligent, try to deliver on time and have good communication with your investors, and everything should be good.
Yes, thank you for that, Stacey. And as you mentioned, that's kind of a broad overview of the various reporting requirements and other commitments. Each developer needs to be reviewing their partnership agreement so that they're complying with it. So thanks for emphasizing that. Investor concern number 3 on our top 5 list, it has to do with the allocation of losses to the investor. And when I say allocation of losses, more poorly, I'm referring to the allocation of depreciation expense. And as a listener, you may be wondering why I'm drawing the distinction about the importance of the allocation of depreciation expense. And it's because investors, first and foremost, want to be sure that they're going to be allocated tax credits and that allocation will be respected. And the allocation of loan-fulfilling tax credits follows the allocation of depreciation expense. So in a typical tax credit transaction, 99.99% the tax losses and credits are projected to be allocated to the investor. And to ensure that the allocations are respected, these allocations must have what's called substantial economic effect under Internal Revenue Code Section 704B. And there's a complex set of regulations that govern this, and subject to certain narrow exceptions, partnership allocations cannot meet the economic effect aspect of the substantial economic effect rules unless the governing capital accounts are maintained according to a very precise set of rules. And the rules are based on tax accounting concepts in the Section 704B Treasury regulations. And that's where oftentimes you'll hear about minimum gain, non-recourse deductions, and a host of other more arcane topics, which we'll be covering here. But just to say that investors want to confirm that the loss, and most importantly, the allocation of depreciation expense will satisfy the Section 704B regulations. And they want the rules to be satisfied at least to the end of the 11-year period over which they're claiming tax credits. And you might be thinking to yourself, is it the 10-year credit period, Mike? Well, the full year one credits generally aren't available because generally you'll be claiming the credits as you're leasing up unless you defer this out of your credit period, but we're not going into that now. So usually the first year will be fewer credits than the full annual amount. And then the amount of credits you don't claim in year one generally will be available in year 11. So there's an 11-year period that you want to be respecting depreciation allocations. And I would say most investors want to go the full 15-year period, such that you have a little bit of cushion if there's something happens along the way. So maybe it's only going 15 or 14 or 13, but won't leak into year 11. So that is kind of the background about the importance of loss allocations to the investor. Stacey, if you could share with our audience some of the ways in which developers can alleviate some investor concerns around loss allocations, or some of the concerns that investors express to you around loss allocations.
Sure. So Mike, that was a very good description of loss allocations and our 704B capital account maintenance rules that we all have to deal with when doing these tax credit developments. So some of the ways to alleviate this is developers and investors can use financial forecasts up front, maybe to spot some issues before the capital account goes negative. I mean, when you're doing the financial forecast, especially using some of the conservative models that we use that we'll talk about later, is that things come up and the forecast, and you can see the capital account going negative and that you may not be able to sustain this capital account. And so there are fixes up front that you can discuss with their investors. It's easier to negotiate deal points and partnership allocations and to get all that written up front and to deal with certain fixes than waiting to the end. So I think that is an important thing to talk about, and where we can talk about some of these potential fixes here in a moment. But I also want to stress before we talk about some of these fixes is the importance of using a CPA that's an expert in partnership tax law. Partnership tax law is very complex, and the investor or the LIHTC deals can run into certain kind of issues and problems. And if you're dealing with somebody who doesn't do a lot of partnership tax, or maybe just basic partnership tax that doesn't get into these issues, you can run afoul of many things in terms of your allocations. And if you can't allocate those losses, especially depreciation loss, as Mike said, you can't allocate those credits. My team is commonly engaged by investors to look at returns that other preparers, CPA firms, are preparing.
Let me just interject there before you switch into that part. I want to emphasize your initial point here about the importance of the upfront projections.
Right.
And the upfront projections will estimate the capital accounts through the end of year 15. And a lot of attention will be paid to whether or not those allocations satisfy the requirements under Section 704B under the safe harbor. And to the extent that their initial draft doesn't, there's as you were pointing out, the various steps you can take up front in order to satisfy those rules. And the real key for the developer is, as you're satisfying those rules, you don't want to be allocating any less losses to the investor than you can, because the greater the tax losses as a general matter, the more equity they'll invest. So they're trying to find the sweet spot of being able to satisfy the allocation rules, as well as maximizing the allocation of losses as early as possible to the investor to maximize the equity. So there is some balance here, which just emphasizes, to your point, Stacey, the importance of having a CPA involved that understands the interactions there, so they can ensure they satisfy the allocation, which is paramount, but also not do it in a way that causes notably less losses going to the investor such that they get less per equity contribution per tax credit dollar. But with that, let's move on to what you were saying in terms of reviewing the actual returns themselves after you're placed in service and leasing up and filing tax returns during operations.
Yeah, because projections are nice, right? But most things don't go exactly as projected.
But,
So
my listeners know what my general rule is. The one thing you know about a set of projections is they will not happen.
yes.
You want to be very close, and most of the time they are, but sometimes there could be changes that are more notable.
hmm Right. And so you might have had some fixes there, or you might have showed nothing, like no issues, so no fixes, but there could be issues that happen along the way. And all I can tell a lot of times that there are issues is when we go in to review these returns, as the syndicator said, here's a group of returns. Can you help us look high level, see if there's any issues? So we see on many occasions issues with tax returns in its final year, like where they're selling maybe the partnership property. And I guess what I mean by that is they're selling the building, one building, and let's say they have a loss on that building, but they expect that their capital accounts, so their partner should go to zero at the end of the day when you liquidate. Generally, they would go to zero upon liquidation. And so what we see sometimes is allocations to get them to zero, but they really don't have the income to, if you have a negative capital account, they don't have the income to restore. Or I guess an example was your investor has a positive capital account. You might have a negative capital account and there isn't maybe enough loss, for example, to get your partner's capital account down to zero because there is gain on the partnership. And so they will have gain on their return, but then on their K1s, they may allocate loss to the limited partner as capital loss and then gain to the other partner just to get their capital accounts to zero. But you have to have one loss, one section like 1231 loss. You don't have different section to bifurcate. And so I see that happen in a lot of ways that partners are trying to do allocations in that last year. And it really stems because there were issues in prior years. So a lot of times it could be the limited partner is getting more losses than expected. And their capital account is going to go right negative. And how do we allocate them income to get their capital account to zero? Because if you file the return with the capital accounts at year end, it could be a flag to the IRS because the IRS is like, well, why do they still have a capital account at the end of the day? Could the loss allocations of prior years have errors? And so that's sort of a red flag, and that's sort of a flag for us to say, okay, well, it's important to monitor all this going forward because the loss allocations that you do through the lifetime have an impact and sort of show up at the end of the day. And so as long as I'm sure we do see allocation issues all the time, they really pop up when we see sales. Because we see some manipulations of income and loss that really isn't there to try to get them to zero. And if the IRS comes in and does an audit and realizes, oh, you allocated them more losses and depreciation expense and credits than expected, then there could be reallocation of those losses. And of course, the investors then don't get the benefits that they originally expected. So
I guess I would just add to that your point about the kind of year 15 being a revelation that maybe some allocations weren't as accurate in the earlier years. I would just encourage developers to take the set of projections that they close with that have the capital accounts and to compare the actual property performance to those projections. And then those projections will, if you're off, you should be trying to identify why you're off. And when you think about a transaction where, quote, losses are greater than expected, normally, if you think, well, what would cause losses to be greater than expected? Well, generally, your project costs and all the rest, depreciation expense and those sort of items generally won't be all that dramatically different. There can be situations where right now we're in a phase out of depreciation expensing, property expensing. And if that were to get extended at the end of this year, then you might find that now your expensing assets that you originally had projected would be a portion of them would be depreciated over 5 years or 15 years for the rest. So there are some of those sort of tax law changes that can have a notable effect. But normally when you have notable difference in losses, it's because you have more cash losses, which means maybe your rents haven't kept up with what you expected, lease up was longer, things of that nature, where you have more cash losses that are generating more losses for the investor. And if you actually read your partnership agreement in detail, normally there are provisions to deal with the allocation of these sort of cash losses, potentially away from the investor and to the developer, to ensure that you don't run into these capital account issues. And that's not something that was in partnership agreements back in 1987 when these transactions first were being underwritten, all the rest. But over the years, as more and more of these situations have arisen, partnership agreements have got longer and more provisions to deal with this. And it's just important that developers make sure they work with accountants that are aware of that. So at the property level, along the way, you're making the proper allocations, and as a consequence, you won't have issues along the way. And the other time I would say that I'm sure you as well, Stacey, will see it, is if it's not getting done correctly for a few years, you won't really see the issue until maybe year 7, 8, or 9. All of a sudden the issue is huge and you've got to figure out a way to solve the allocation issue. So I want to move on to the fourth concern, but I would just say here with loss allocations, the key is to have a set of projections, ensure the projections show that you don't have a sub or B issue for the adequate period of time. And if you compare your partnership prepared return every year to those projections. And with that, I'm going to move on to investor concern number 4, unless you wanted to add something.
No, I think that was pretty much what I was going to add. Just making sure you're updating your forecast yearly and look at potential fixes ahead of time. Don't wait that year. I just do want to note too, if you do find an issue, you can amend that partnership agreement to maybe fix some of these, but you have to do it by the original due date of your tax return. So by March 15th. So if you have a 12/31, calendar year end, when you do find an issue, and say, okay, maybe if we implement these certain changes and both partners agree, you can do that by 3/15. But if you're going to file an extension and then start dealing with the tax return in May, and then all of a sudden it comes May or during the return, you're like, oh, we ran into this issue. It's too late. So you can't deal with it for that year. You have to wait till the next year to the partnership agreement.
Yes, that's a great point. Just listeners should know that sometimes these issues get solved through an amendment of the partnership agreement. And as Stacey mentioned, you have for calendar year taxpayers through to make those changes as a general matter. So with that, let's move on to investor concern number 4. And it does deal with the end of the investment period. And it kind of ties in a little bit to what I mentioned earlier about you want to run these projections and look at your capital accounts and all the rest. Well, when developers, syndicators, and investors run these initial projections, generally they're written where you project 2% growth in rent and 3% growth in expenses. And I do say generally, because in these recent inflationary times, these sort of growth projections it's been a big question as to what assumptions should we use? And then obviously on the rent growth, some will look at the rent growth and conservatively not show any rent growth for a couple of years and then start to grow it. There's a variety of modifications to this in a given transaction, but generally rent's growing at 2%, expenses at 3%. And these assumptions are intended to be conservative underwriting assumptions. The idea is we want to grow rent at 2%, grow expenses at 3%, and show that the project from a cash flow perspective is financially viable over the 15-year period. They are intended to be conservative. And as I note, you have this greater probability of financial feasibility over the full 15-year period. As a consequence of the conservative assumptions, when you look at any sort of sale or residual cash at the end of the 15-year period, well, rents have been growing at 2%, expenses at 3%. So your net operating income isn't growing as much as it would otherwise grow if they're growing at the same pace. So oftentimes in year 15, when you throw a cap rate and all the rest, you estimate cash on sale, there isn't a large amount of sale proceeds to be distributed among the partners in the partnership. That's great for underwriting purposes, and that might be the set of projections you use to close the transaction and all the rest. But most real estate owners actually expect their rent growth to at least keep pace with the growth in expenses. And if you take a set of projections and you assume rent's growing at the same pace as expenses, then in reality, over that 15-year period, your NOI will be growing then at a similar rate. And at the end of year 15, depending upon how cap rates change and all the rest, you could have a notable residual value. And my comment here, that what Stacey and I discussed in preparing for the podcast, is that many investors do expect to share a portion of that value. And I thought, Stacey, you maybe could elaborate on these sort of evolving investor expectations towards the end of their investment.
Yeah. As you mentioned, Mike, a lot of that upfront underwriting is conservative, and you have these projections and they show the investors getting credits and losses, and that's what's on the partnership agreement. You don't see the residual in there. So as these partnerships are more profitable and they end up liquidating some of their property, there is cash available, and according to the partnership agreement, it will be distributed based on that partnership agreement. So now there's probably more cash than expected that wasn't underwritten that's going to go to the investor. And we're talk about here in the next concern about maybe how that's allocated to the investor, or maybe what the investor expects. But you don't want any surprises. You want to make sure that if you're thinking that the investor is going to walk away with nothing, because that's how it's originally projected, or maybe that's what was sort of agreed upon at the beginning, like a handshake deal. Oh, maybe I'm a nonprofit investor in there. I don't want anything. I just want the good of the order. I want tax credits and losses. But you have to understand that, I mean, it's a long investment. It was generally a 15-year investment that management at the company might change hands. You might have a sale and your investor might sell their interest. And so they might just not walk away with anything. They are going to look at the partnership agreement and say, well, if you sell the property or if I sell my interest, how am I going to be compensated? So making sure that up front, when you're putting together this partnership agreement, that you're actually looking to see, well, what happens if I do get residual at year end or at the end of the day, for example, or liquidation, and making sure that your partnership is reading as you expect the distributions to go, which we can talk about in depth.
But let's actually talk about that. You hit the sort of the nail on the head here, is that it's important that at the beginning, you're beginning with the end in mind, and you're beginning with the partnership agreement, thinking about year 15 and not looking at the conservative underwritten projections, arching much residual, and thinking that that's necessarily what the investor expects, and having those discussions with your investor about what they actually expect to see at the end of year 15. And if you're a nonprofit, there's rights of first refusal. You can make sure that that language is as strong as possible. There's a variety of issues sort of at play there. And it's just most important that it's thought about up front, because as hard as it is to believe, 15 years gets you before you know it. as we prepare to celebrate our 34th year as a firm. So let's move on to the investor concern number 5, which, as you were noting, kind of builds off of number 4 in terms of cash residual at the end. In the last few years, there's been a lot of cash residual at the end, in part because cap rates have fallen so much more dramatically than the cap rates where they were 15 years ago. We'll see with higher interest rates and a higher 10-year treasury and a 20-year treasury, what extent cap rates get adjusted accordingly. But the tax credit partnership agreements, generally speaking, will have a cash waterfall section on the net proceeds from the sale of the underlying assets. And that provision might provide an 80-20 sharing ratio or something like that, 80% developer, 20% to the investor. But as I mentioned earlier, in order to ensure the depreciation goes to the investor so they get the tax credits, partnership agreements have to satisfy these Section 7 of RV partnership allocation rules. And liquidation of the partnership has to be done in accordance with those rules. And those rules provide that liquidation has to be done in accordance with relative capital accounts. And what this means is that an investor has a large positive capital account at the end of 15 years. And generally speaking, that won't happen when you're doing a tax and bond deal with lower credits. But if you do a 9% tax credit deal, a difficult developer or something, you can find that at the end of 15 years, the investor has a positive capital account. It may also be because you're projecting 2% rent growth, 3% expense growth, and the rents ended up growing at 3 or will grow faster than the expenses. So you had more cash flow and even more residual, and you had less tax losses or cash losses because you had more rental income. So you had more income. So your losses weren't as much. So you can have these larger positive capital accounts at the end of year 15, which may mean that the investor's entitled to a greater share of cash on liquidation. So you might find they have a large capital account. So if you looked at 20% of the net sales proceeds, they get X amount, but because of the large capital account, they're entitled to Y. And that's been something that has surprised many developers in looking at their partnership agreements. So that's obviously a pretty basic overview. And for those of you listening, feel free to reach out to Stacey to get kind of more details on that. But for purposes of the podcast, Stacey, if you wanted to share some other considerations developers should be thinking of when they're looking at year 15. I kind of talked about the cash waterfall sharing ratios, the positive capital account sharing ratios, how they could be sort of in conflict a bit. And then there's also obviously other ways for developers to be arranging exits with investors.
Right. Yeah, you hit upon the liquidation, and that's really key. And like you said, in order to preserve those losses, the investors are going to want you to basically use that safe harbor that's in all the LIHTC partnership agreements about maintaining those capital accounts and distributing in accordance with those positive capital accounts. And so that's why there's that push. However, there are court cases that may conflict with this interpretation that developers need to be aware of. But from an investor perspective, to make sure that they maintain those and satisfy those requirements, they're going to want to do liquidations according to those positive capital accounts. Another issue is that you may not actually, at the end of the life of this investment with your partner, sell the property. Maybe you want to keep the property and operate it for yourself. So maybe the thought is that you're going to, in essence, purchase the limited partner's interest in the partnership. So you're going to wholly own this now, and now it's your partnership and your property, and you're going to operate it through its life. So the issue comes with the buyout. So the question is how is that structured, and how is the investor going to value their interest? So as I mentioned before, will the investor be, I got my credits and my losses, that's what I wanted, and maybe they're not really expecting much. But like we said, as maybe the value of these properties have increased, what I've seen a lot is that the investors want paid for that, for their interest. They want paid for this value. And a lot of times they're basing it off of, what would I have gotten if we did do a liquidation? We did sell the property. And so I've been involved with many calculations that the investors want us doing these hypothetical liquidation of the partnership, meaning that if you sell the property at its fair market value, you pay off all the debt of the partnership, how much cash will the investor receive? So we go through and we do those calculations to figure out where those capital accounts will end up. And so that's in a lot of cases, we see investors valuing that capital account like that. So you're paying possibly, and it of course is a negotiation, they're expecting what that value of that capital account would be if you hypothetically liquidated at a certain point in time. Another thing to be aware of too with the buyouts is that exit taxes are sort of common in these partnership agreements, where they are allocated a gain at the end of the day on these sales of liquidating interest, that a lot of times they want a priority distribution to pay those exit taxes. So if you're allocating them a gain, they're getting their tax rate, federal and state tax rate times the gain they're getting allocated to pay those taxes before other distributions. So just something to keep in mind when you're expecting the cash on the back end. So I want to talk about there's some upfront planning and partnership agreements that you can do to sort of get that result that you want, right? So as Mike mentioned, there are a sale and refinancing cash flow waterfall provisions in your partnership agreement. But as he mentioned, you might have to distribute in accordance to this positive capital accounts, and they conflict. Well, a lot of times those partnership agreements can have provisions in there of how to allocate your gain or loss on sale of your properties. So whenever you dispose of sell your building, you're going to have a gain or loss. And some of the ways to combat that, your liquidating distributions would be the same as your cash on sale refinancing distributions, is to have special provisions in your partnership agreement to say you're going to allocate this gain or loss to make the capital accounts equal what they would get in the sales waterfall provisions of the partnership agreement. And so that is, I think, I don't see it in all, but I think it's very important that if you're expecting to get cash at a different percentage in your sales waterfall, that you have some of those special allocations of your gain losses in your partnership agreement. So you put that up in front. And I always suggest too, to again, up front, model this out, stress test this. Will the partnership agreement and how the allocations and the loss allocations, gain, cash distribution allocations, will it get me to the results that I want and I expect? Or is there a surprise? So make sure you're stress testing stuff, you're running through stuff. And it might not always fix stuff. For example, Mike mentioned that large positive capital count at the end. You might not have enough loss, right? To be able to allocate, especially allocate that partner to get them down to 20% and have your developer at 80%. And so that's where, even if you have some of these provisions in there, you can run into some issues of not being able to get where you want to go. But you can also, if that's sort of what you're expecting and that's what the investors are expecting or okay with, toward the end of the deal, there could be, like I said, amendments to partnership agreements where you could change some allocations to maybe start allocating more income to the general partner if they want it. Again, you're getting fan income because you're not getting distributions yet, but you make it this distribution if you know in a couple of years that you want to sell it because your capital counts are positive. So there are plus and minuses, but again, I think it all comes into upfront planning, making sure your partner agreement is reading as you expected, and then start monitor, not in the year that you want to sell it, or not the year before you want to sell it, but a few years before you want to sell the property. Monitor what's happening and see if there's anything that you can do to make the economics match, the allocations match what you want the economics to be.
No, I think those are all good points. And it really emphasizes the importance up front to be thinking about the exit. And I think your point, Stacey, about running sensitivity testing to show higher rent growth and the rest so that there's more value at the end and seeing how it works through the partnership agreement. Obviously, if you're a nonprofit managing your partner, you can be thinking about rights of first refusal at debt plus taxes. For-profits can be thinking about the right to buy the partnership interest at fair market value. And there's a number of other provisions that you can put in a partnership agreement to help address the range of outcomes. And it shows the importance of running the financial models and the rest, but also having a law firm that's experienced representing investors and or developers, certainly one or the other at least. And as such, they know some of the provisions that they've used in other agreements, and they can help educate the developer on some of the provisions to be thinking about the exit in year 15. Like I mentioned earlier, back in 1987, 89, a lot of thought wasn't given to provisions on exit and the rest. This day and age, a lot more attention is going in up front on dealing with some of these investor buyout options. So thank you, Stacey, for joining me on the podcast. Before I let you go with this part of the podcast, I wanted to see if you had any other tips for developers when it comes to understanding investor concerns.
Yeah, I guess the main thing is develop a good relationship with your investor. Make sure you're establishing timelines so you're meeting the administrative deadlines. Establish a good communication protocol with your investor. I think another key thing that keeps coming up in here is to adequately plan, adequately forecast, and track that progression of your investments. And you might do this forecast up front, but you need to continually monitor the product and the project and the deal and what's going on so you can deal with any foreseeable problems before it becomes too late. And then I just definitely want to state, as Mike mentioned, whether it's attorneys who are versed in this area or accountants, definitely work with industry experts, who's industry experts in partnership tax law and in the industry to help avoid any potential pitfalls.
Great. Thank you, Stacey. Please do stick around for the off mic section, which I get to ask you some fun off topic questions to give you the opportunity to share some words of wisdom with me and our audience. And to our audience, please tune in for next week's episode. My partner, Tony Doponi, he and I have a very timely topic for our renewable energy audience. We're going to discuss two major areas. One, we're going to discuss tax and financial reporting recommended practices. So we'll share our thoughts there, which is a bit of an overlap with this podcast where we had this section about the importance of developers meeting their tax and financial reporting deadlines. And then the second area is some of our top tips for a successful closing this calendar year. We have a number of renewable energy financing facilities that are looking to close before the end of the year. We want to share some tips now to avoid surprises and delays as we get closer to December 31st. And as always, if you have any questions that you suggest we cover in a given episode, for instance, this upcoming renewable energy audience episode, please email me at cpas@novoco.com. So we now turn to our off mic section where I get to ask questions, some off-topic questions to share some insight with me and our listeners. So one question I love to ask guests, Stacey, and I know I've not asked you this before since you haven't been on the podcast before. Share with us one of your favorite work-life balance tips.
Sure. So I really don't like to use the term work-life balance. Whenever people say work-life balance, I feel that implies there's a scale and the scales are tipped in one direction or another. And I feel I don't want it tipping of the scales between work and life. For me, it's more like work-life integration. I feel to suggest a better harmony. So I give like equitable attention to all aspects of my life. And I guess one way that I do that is I have one schedule, one calendar, and I'm a scheduler, right? And so I make sure both my work and my personal functions that are important to me are on my one schedule. And so if I have something very important for my personal life, I can schedule my work appointments around that, or vice versa. I have a really important work appointment and make sure personal gets scheduled around that. So you're not missing the important things in life and with your family. And so I guess the one thing that I learned that sort of becomes hard about doing that and scheduling that personal time, maybe the work appointments around the personal time, is not feeling guilty about doing that and having that flexibility to make that happen in your schedule. For CPAs, we work a lot of hours, but you don't want to miss important things in life. So just having some flexibility on how that works out and making sure everything's in one schedule sort of works for me.
Well, I really like your phrase, equitable attention to all aspects of my life. So I'm going to give some more thought to that. That really could use some unpacking, and the depth of that sentence is very, very strong. So thank you for that. So I'll go, I'm not sure where this fits in your work-life integration. I like that. I like that as well, as opposed to balance, because it's not quite as binary. If you were at a trivia night, what category would you know best? And then share with me how you came to be an expert in the area. And let me start by saying, long housing tax credit is not an allowable answer. So if I took your answer away,
Yes, how do you know that?
took my answer away in there.
Yeah. So if I'm not working, I can't use that. I'm usually spending time with my family. And so that usually centered around sports. I have two boys. And so, they both had a passion for baseball. So I might say baseball trivia because I spend most of my time watching baseball at the baseball field. Or I guess one of the things I like to watch with my boys too is college football. It's my favorite thing to watch on TV. So maybe some college football trivia. I have a son at Ohio State this year. He's a freshman. And so I'm jealous he gets to go to all the home games. So go Buckeyes.
There you go. The Ohio State. Great. Thank you, Stacey. And to our listeners, I'm Mike Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac and Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public.